Good afternoon, everyone. My name is Farhad Agdami, and I'm the managing partner of the Richmond office here at Williams Mullen. And I'm joined today by my colleagues, Conrad Garcia and Christine Pearsall. Conrad is the chair of the tax department here at Williams Mullen and focuses primarily on business tax related issues. And Christine is the chair of our private client and fiduciary services practices here. She's works in our Hampton Roads offices, both in Virginia Beach and Norfolk, and she'll be leading our discussions on the wealth transfer tax planning arena. What we thought we'd do today is spend a little bit of time going through the various candidate proposals involving from both President Trump and Vice President Biden. And then we'll spend some time talking about some of the planning implications of things that we see and the things that we're talking to clients about in terms of planning that they may want to consider, depending on what happens in the election, and then we'll open it up to some Q&A. In the Zoom, there's a chat box feature, and you can pose questions to us, and we'll be happy to try to answer them at the end of the session. So, at this point, I want to maybe turn it over to Conrad and see if he can maybe walk us through some of the business tax corporate proposals and what both Biden and Trump have proposed, and we may talk a little bit about the implications to our clients. So, Conrad?
Sure. Thank you, Farhad. Hello to everyone, and thank you for spending lunchtime with us. So let's start going through this material. The first item is we'll talk about corporate tax rates, and what I'm talking about is taxable C corporations. When the Tax Cut and Jobs Act was put in place by the Trump administration, the corporate tax rate used to be very expensive at 35%. When Trump came in and made his change, they got it reduced to 21%. And if you look at that, that was a substantial reduction in corporate level taxes. Biden's plan, there's really two things that he's looking at. The first is he wants to increase that rate to 28%. And the other thing that, if you've seen any of the publications, is you have all these very large multinational companies that are showing significant amount of income for GAAP purposes or their earnings, but they never pay taxes. And what he wants to propose is a 15% minimum tax on book income. And as you can imagine, that's controversial, and there really hasn't been any details about how are you going to compute that. So, but there is an alternative proposal to try and make sure that everyone's paying taxes, especially if you're like Amazon and you're showing all these hundreds of millions of dollars of book taxable income, but never paid any income taxes. As for Trump, he wants to say the status quo. At one point, he said he really wanted the rate at 20%, but he hasn't had any real formal proposal. So I think that's very important for taxable corporations, is to understand the impact. One side note that people have not picked up on is a lot of corporations are indicating, and these are publicly traded corporations, that going from 21 to 28 may not be that significant, because for those that were running losses, their deferred tax asset value went down, and this would increase it. So it may not be an impact on their earnings as significant, is what I'm saying. The other issue is depreciation. The same thing in the TCJA, we had immediate expensing, and then eventually it was going to phase out all the way into 2026. Biden hasn't talked about that specifically, but I think we'll talk a little bit about some real estate proposals, and maybe it will be impacted. As for Trump, he's basically said, I want to extend the full expensing, and in essential industries like pharmaceuticals and robotics to bring back manufacturing, he wants to accelerate that depreciation, what we're looking at. So real estate has been a big issue recently in the campaign. It's been an issue because someone pulled Trump return, and apparently he paid $750. And for all of us that work in this industry or tax lawyers, real estate people don't pay taxes. There's a combination of interest expense and depreciation expense, and when they're going to sell a property, a lot of them may choose to do a 1031 exchange to defer that gain, and so you're just constantly in a deferral mode of taxes. So that didn't really, so as I should say, it didn't surprise any of us here that do this type of law. Um, One of the things that Biden has continually said is, I want to get rid of unequal tax breaks for real estate investors. And you'll see some income thresholds over folks who make over 400,000, but it's everyone. But one of the things that people are speculating is that he'll eliminate the like kind exchange. And that would be a significant change in the real estate industry. It has a very strong lobbying industry, and I'm not sure how successful that would end up being. Prior to this, Obama at one point had suggested placing some limitations, like you could 1031 out up to a couple of $1 million. But, we'll have to see where things end up ultimately. With Trump, he'd like to keep the law the same for all real estate investors to keep it consistent with prior years.
Hey, Conrad, a couple things I want to maybe ask you first. With regard to the 1031 like-kind exchange as to real estate, the 2017 tax bill eliminated it for everything other than real estate. Is that right?
That is correct. It did. And part of the theory behind that is personal property. If you went and bought it, you get to expense it 100%. So that was the trade-off. So yeah, that is a correct statement. It's real property, and there's been some issues about what is the definition of real property, but that's a correct statement.
And then going back on the corporate tax rate, we certainly after 2017 or in 2018, with the drop in the tax rate, we saw a number of S corporations convert to C, under the theory that if you're going to retain your earnings, it may be beneficial to actually become a C corporation. If the tax rate increases, so if the corporate tax rate increases, do you have a sense of, does that change the equation? And can S corporations that elected become C corporations, how long do they have to wait before they can go back to being an S?
So let's do the second question. If you made a S to C, and now you look at this and maybe you want to go back to an S, there's a 5-year prohibition from the time you made that election. So you got to wait that time. I think Farhad, the first point you brought up is what's going to be more productive. I think that it depends on what industry you're in. And when we go forward in this PowerPoint, we look at individual rates, it's going to really be something to think about how you deal with that. Yeah. My gut reaction is you may end up balancing, but when you see the changes to the individual rates and the potential for double tax, my initial reaction was maybe the C Corp does not look so attractive at that point.
Okay.
We'll have to consider that.
We'll revisit that when we get there.
Sure. So I think this is a good lead into what Farhad was talking about is, payroll taxes. Most folks are like, okay, we pay payroll taxes and it goes in. I think you look at the general rules, you got 12.4 is what you pay employer, employee, or self-employed. You got the 2.9 that never goes away. And then S Corps, you've always had this issue of, can I pay myself low comp, not unreasonably low, take a distribution and avoid payroll taxes? I think the biggest change here for the Biden plan is if you have over 400,000 of wages, he wants to create a new Social Security tax that's basically going to be 12.4%. And it would apply to wages over 400,000. So you'd have this, we have a donut hole there from 137,700 to 400, but to 400,000. Once you get to 400,000, this would kick in. If you think about it, we'll get a little bit further to this, but one of the things is that the effective rate that folks who make over 400,000, once you get over that 400,000, if you add in the payroll taxes, the Obamacare 0.09%, the Medicare, the effective rate that you can pay is going to be around 50%. In high taxes, it's going to be roughly around 60. So I think that's something for wage owners to look at is, if you're in a company, whether it's an S Corp or C Corp, you're going to have to weigh the payroll tax versus the additional income tax. And I think you'll see a lot of modeling. As for Trump, he tried to put that incentive in August about deferring the payroll taxes on wages. He's looking for that to get retroactively approved, and he has not had any specific comments on payroll taxes.
Well, I guess let's kind of continues on the conversation about C versus S, because if you can avoid employment-related compensation and draw more out as S corp distributions, you really avoid that Social Security tax.
That is correct. That is correct, and we'll get that far when we get there. So I think here's the thing that we've really been talking about is, if you look at the ordinary rate right now, our top rate is 37%. Biden wants to go back to the old rate at 39.6, but it's only for people over 400,000. Everything with him is 400,000. If you want to look at the Trump proposal, he wants to make everything permanent, okay? Because he couldn't do it through how he passed it through Congress last time. He'd like to make all these cuts permanent. I think probably the biggest change you'll see are capital gains. This is a substantial change that Biden has on his proposal. And it's basically, if you make more than $1 million, capital gains will be taxed at 39.6%. So if you really think about it, this, where people have been comparing, if I invest in stocks and bonds and can sell them, and a person working, that the rate play is, the guy working has to pay 39.6 or 37 now. You pay 20% of capital gains rate, and they have a lower effective rate. Biden's proposal is once you get over $1 million, there's no rate disparity anymore, and characterization would only matter if you have certain losses in buckets. And I think this is really important because if you're an individual and you get above $1 million, you're doing a stock sale, a membership interest sale. We used to do all this planning to get capital gains. The issue is if that gain is over $1 million, it's now going to be taxed at 39.6%. And it kind of eliminates the, how long did you hold something? Is it a carried interest? We'll talk about that. And I think this goes back to Farhide's point of when you're looking at a C Corp versus an S Corp, it is now like, hypothetically, if you sold all the assets of a C Corp, you'd pay 21%, you'd pay that corporate tax and you dividend it up, and you'd pay another 20 and you're at 41%. Under this situation, if you're a C Corp and you sell assets and these proposals are implemented, for anything over $1 million, your federal effective rate will be 67.6%. And that's 39.6 plus the 28% inside the company. And that doesn't even factor the state rates that could impact, that could get you probably up to 72%. So I think that now when you're looking at this is if you wanted to go to a C Corp and say, well, it's at 28 and the individual rate is at 39.6, the question that we always deal with as tax planners is on an exit transaction. If you don't want to sell assets, what are the types of discounts you're going to see for your equity? Because no one's going to get to step up those assets, and you're going to have your purchase price going to be stuck in the stock. And this two rate's going to be really important, I think, for folks that can utilize joint ventures and have plans of long-term hold. Maybe you use a C Corp, but this rate differential is very significant, given that capital gains after $1 million may be taxed at an ordinary rate. And Farhad, I don't know if you have anything to add or your thoughts on the capital gains and whether you're seeing anyone accelerate sales or anything because of it, this year.
We've had clients, ask whether, they've expressed some interest, like maybe we should go ahead and sell an asset now. The hard part is it's both a sale but then also a purchase, that they've got to, buy something else, and thinking about how they may want to reinvest presents a challenge, because they may have to buy, higher priced assets. And so, but, I think there is some thought that, when capital gains rates go up, you often will see some type of sell-off. I think at this point, we may have some more clarity next week, but
Sure.
certainly selling based on speculation of what may happen is probably not a good idea. I think we'd want to know that the taxes are, that they may be changing. When we get to the end, we'll talk about maybe timing in terms of when we think things could happen, and depending on the outcomes and frankly how severe the tax increases might be.
Sure. So, in looking at this side, looking at individual changes, one of the things are real estate hedge fund managers and some of your startup companies, you give a lot of people called you give promotes or carried interest. And in the real estate, a carried interest, and now there's a defined term under Code Section 1061. You have to have a 3-year holding period. And this was Trump saying, I think the hedge fund folks are really getting a windfall, and I'll go ahead and agree to 1061. Well, if you read that section, they carved out 1231 gain, which is basically real estate gain from rentals. So that statutory provision, there's a lot you can do and manipulate things to get around that 3-year holding period. Biden, if you think about it, he said, I want to tax it at ordinary rates. But I think this gets a lot easier is once you get over through that $1 million threshold on capital gains, then boom, you have the ordinary rate, and there's not much you can do with that. So that you see is going to be something that Biden would look at taxing, and maybe he can do it under the $1 million threshold. The other thing is you've seen all this QBI. When Trump came out, if you're in a pass-through entity, partnership, or an S corporation, if you had the right kind of income and right kind of wages, you could take this 20% reduction that basically took the 37% ordinary income and tax it at 29%. And I know that Trump, there's been some indication he wants to make that permanent. It's a real complicated statutory, and I know the accountants have done a lot of work trying to figure out what's good QBI. You look at wages, you also look at, what you bought. Well, Biden is very simple. He says, I'll keep 199A, but if you get over 400,000, we're going to eliminate it or phase it out. So again, 400,000 limit. You go to itemized deductions, with Trump, we saw a higher standardized deduction. If you get over the threshold, you can do itemized deduction and there's no limitation. Biden basically wants to go back to the old way and probably let you put state and local tax higher than a $10,000 threshold, but you'd also have the cap at 28,000 over 400,000. So again, it's a consistent $400,000 work. All right, let's go ahead and go to the next slide. I think the payroll, we've got into this already. This is just a little bit more in depth about the Medicare and Obamacare taxes and how they apply. I think we can go through this one hard and cover it towards the end. And I think with retirement savings, what we're seeing with Trump is he doesn't have any current proposals. There's been some discussions. You'll see with Biden, he wants you to have more hardship issues that you can take money out of your retirement plan, for domestic violence survivors, emergency access to funds. He also wants to give caregivers catch up to retirement accounts. And he's trying to make it so that you can have more tax treatment for folks, in lower paying sort of brackets and upper paying for the savings accounts. So I think when you look at all these proposals, in summary, what you're seeing is it's not a lot different than what you're hearing on the campaign. And that if you're Trump, he's trying to keep the status quo. He's trying to make permanent some of his things that he could not make permanent. And for Biden, that $400,000 is the key to his entire tax plan. That is kind of the springboard to higher rates, greater payroll taxes, and if you have capital gains over $1 million. And I think with that, Farid, we can talk about some things that we've been thinking about or that comes up all the time with considering these changes.
Yeah, I mean, I think we always struggle in terms of how we structure entities, C versus S versus LLC, and on the one hand, I felt like the pendulum shifted towards the C corporations after the 2017 Tax Act, just because of, the ability to have the capture the income at the much lower rate, especially if you're accumulating. Now it seems like on the one hand, earned income and having a low number in terms of earned income. So if you're a business owner, you're in an S corporation, pay yourself a reasonable but low end of the range salary and pull as much as possible out as S distributions. That seems to make a lot of sense to avoid some of the, the Medicare taxes. But at the same time, it may push you up into higher income amounts, that cause you to get taxed here. So it sounds like there's not necessarily it's going to require a lot of modeling. But do you have a sense of how folks should be thinking about it?
Yeah, for me, what I look at always is we hope we can sell a business, and it's, and the issue I have here with the C corp is I agree with everything you're saying, but if you look on a C corp, the real question is, how does the market get impacted if someone's going to buy stock? And because I can't imagine anyone doing an asset sale with an effective rate of almost 70%. And what's the discount you take? And do you weigh that versus converting to an S corp or looking at an LLC? Or if you're now a C corp and you can elect, is there something else out there at 1202, or do you take your business and put it in a partnership and let it grow? I think the one thing that you did hit on is there's games to be paid between, $0 to $1 million, but it seems like once you get past $1 million, of course, we've got to see how this all gets passed. Are you really done with your planning because everything's at 39%?
Yeah.
I think that's the hard question looking at it.
Great. Well, thank you, Conrad. I
Thank
think
you.
we're going to shift now to Christine and talk about some of the wealth transfer tax planning things that we're seeing, and maybe have Christine first go over kind of what we're seeing in terms of what Vice President Biden and President Trump are proposing in terms of the exemptions and basis and those kinds of things.
Thanks, Farhad. Good afternoon, everybody. Thanks for joining us today. So I'm listening to Conrad, and I feel like we're having whiplash because we just went through the tax law changes not so long ago, and now we're talking about potentially more taxes. But it's relevant. I mean, we're not sure what's going to happen next week, and so and as Farhad and I have been slammed the last few months, meeting with clients, and and there could be some dramatic changes in the estate and gift tax laws based on if there is a change in administration and a change in a blue wave. So Biden's current proposal, the way the current law it works is that there is a step up or step down in basis at death based on what the fair market value is on the asset. So there's no capital gains. You might be subject to an estate tax, but you don't have to pay capital gains on top of that. So that doesn't make it a double whammy. Biden's proposal currently discusses an elimination on the basis adjustment. So there wouldn't be a step up. So we would have carryover basis. And then there's a question of would there be a recognition at death? And we'll discuss that with the next slide. But the current law as it stands is that in 2018, the 5 million was double, then it became, it's currently $11,580,000 with the inflation adjustments for 2020. The way the law is written, if Congress does not act before the end of 2025, that $10 million number goes back to 5 million adjusted for inflation in 2026. Trump has proposed that the double exemption would be permanent. And, that would also require a red sweep. So it'll be interesting to talk about what kind of predictions that we think will happen. But let's go into a little bit more about what Biden's tax proposal would be. And we don't have a whole lot of information about it, not sure how it works, because we've been living with this regime of you've got your everything gets a step up, you've got an exemption, the exemption's been increasing over time. I know that, when I started practicing, it was $1 million, now it's at 11 million. So there's been huge adjustments since in the almost 20 years that I've been practicing. And So we understand that regime. We understand what that means, that they get the step up, everybody plans, they hold on to the lower basis assets, so then you get a stepped up basis at death. Um, so, one of the things that Biden is talking about also is, why don't we keep the regime that we have, but perhaps with the lower adjustment. We're hearing maybe going back to where it was. Biden can just wait it out until 2026 and just let it just automatically expire on its own. Um, Talking about the elimination of the basis adjustment. Again, we're not really sure what it looks like. We saw some glimpses of it back in 2010 when there was no estate tax, and there was some individuals and some estates that some people died that year that ended up paying no estate taxes, but they had limited adjustments for what they could increase their basis. Because of course there's going to have to be some sort of lower adjustment for individuals who aren't wealthy, who are planning, you're inheriting $100,000 of stock from your mom and dad, and that's all you're getting. Do you have to recognize that capital gain at that point? So we think that that's what it's going to look like, but we don't have a whole lot of details. Another option about the basis, not having the basis adjustment, is, death becoming a realization event. It's similar to the way that they do it in Canada. And so basically someone dies and then death is a realization event and you pay your capital gains. And it's reported on the decedent's 1040. So that could be another possibility of what would happen.
I think the hard part is, the Biden proposal, really, we just haven't seen a lot of detail. And so there is some speculation as to what, elimination of the step up in basis at death means. I think these are two possible options. We've tried carryover basis twice, I think in 1976, and that was eliminated because, frankly, the financial institution said tracking basis is really hard. Didn't have, obviously, the sophisticated computers we have today. And so they really approached Congress and said, having a step up in basis at death is really helpful because we can go back and say, well, this person died in this year. And so we know what the value might have been. And so there is some help there. They also did it again in 2010 as part of the year where they eliminated the estate tax, but then it came back again. But, one of the things that we see, certainly with clients that are real estate developers, they buy an asset, they depreciate it over a period of time, and they may refinance it. They may, pull money out of it, even though it's appreciating. And that asset has a very, very low basis. It may have a negative basis at the time of a person's death. If we're subject to those carryover basis rules and we don't get the step up in basis at death, it's going to have pretty significant impact, certainly to real estate, but really anybody who has, highly appreciated assets. And as Christine said, this Canadian tax system with the sort of death becoming a capital gain event could be part of, I think, a simplification proposal to say, look, let's just get rid of the estate tax, and maybe Biden could claim victory, say, look, I got rid of the estate tax, and really what they're doing is trading it for a capital gains tax at death. So I think it's all kind of interesting to see what will happen. I guess one thing I'll mention to you is, if Biden is elected and they decided to start tinkering with the estate tax, very often Congress will look at bills that have already been introduced. And Senator Bernie Sanders last year introduced the what it's called the 99.8% Act, which is really essentially a tax on the 0.2%. And what he is proposing is to reduce the estate tax exemption amount from $10 million to $3.5 million, and that would not be inflation adjusted, and reduce the gift tax exemption, so decouple the estate and gift exemption and reduce that to only $1 million. And then he would also raise the current 40% rate from 40% to from anywhere from 45% to as high as 77% for folks who are having estates over $1 billion. So pretty significant tax increases. I will say, when I started practicing, I guess 28 years ago, the top tax rate was 55%, and in some cases 60%. So I would say the 55% rate is not unheard of. I think it's confiscatory, but it's not unheard of. It's not without precedent. The other thing that the House version of the Sanders bill includes some additional provisions that create some concerns for us. Frankly, takes a lot of the fun out of what we do, what Christina and I do in terms of planning. It would largely eliminate valuation discounts in closely held business entities. There's a particular planning technique called a GRAT, a Grantor Retained Annuity Trust, and typically those are 2-year terms, and they have very small remainder interest. They would essentially take all the fun out of GRATs by requiring a 10-year minimum term and a minimum gift of, I think, $500,000 or 25% of the contributed value. And then also we use what are called grantor trusts, intentionally defective grantor trusts, as a vehicle to transfer interest primarily in closely held businesses. And these proposals would really take a lot of the fun out of that. It's interesting though that these bills, at least at this point, would only apply to trusts created after the date of enactment of the statute, or assets gifted to or sold to the trust after the date of enactment. So I think there's still, these things happen. I think at least for the time being, there may be an opportunity to do some planning, but it really does take frankly, a lot of the fun out of what we like to do. And Christine, could you maybe talk about some of the things that we are doing in light of this?
So, we all know we have 11 and 11.58 per person. So, for our clients that have the ability to make these type of large gifts, we're telling, let's go ahead and make the gifts. We've been talking about it since 2018 that we should do it. We had some, we said, well, I'm not going to really push you until closer to 2025. But the reality of it is we might not have this exemption, but we currently have it. So, let's go ahead, if you're able to, let's go ahead and make those large gifts. Some have been outright. I'm not, I'd rather, because you've got the generation skipping transfer tax exemption also, so that we can utilize to do more creative gifting, so that you're getting assets not out of just your estate, but out of your children's estate. And doing things like Farhad said, the intentionally defective grantor trust, where, for income tax purposes, the trust is still treated as belonging to the grantor, but it's a completed gifts. And there's some really good techniques out there. We did a whole bunch in 2012 where when we thought the exemption was going to go back down to $1 million, called Spousal Lifetime Access Trust. So for married individuals, they can set up a trust for each of their they can set up trust for their spouse, and so kind of getting your cake and eat it too. So as long as you keep your spouse alive, make sure you don't get divorced, that the grantor since the spouse is a permissible beneficiary, can still get access to the assets that were transferred in the trust. It is a completed gift, so you use your exemption, and any of the appreciation that you put into the trust after the date of the gift grows estate tax free, and so it's not going to be includable in either spouse's estates at the death of either of them. So that's a really nice. It's hard when I'm telling my clients you're married, you've got to give $23.16 million worth of assets away. And for them to really stomach it, having a spousal lifetime access trust is good, because you still, to a certain extent, have access to it. Now, there are certain restrictions that you have to have on it. I mean, you can have your cake and eat it too, but obviously you have to keep up with formalities, and there are restrictions that you need to be aware of. There's reciprocal trust doctrines, step doctrines, step transaction, that's making it kind of hard. A lot of the clients we've been talking to since 2018, and so, you've got an increased exemption, let's make additional gifts. And they haven't done anything. And if they want to do something before year end, it's kind of hard if only one of the spouses has all the assets. So we're working with it, but that is one of the things I've been setting up in the last few months. Just setting them up and then, waiting to make the gift. Or if you're not married, you could do a single grantor irrevocable trust rather than an outright gift to utilize the generation skipping transfer tax exemption, so that it's not includable in your in the child's estate. The defective grantor trust are great because they are treated as being income taxed to the grantor. So then the grantor, as long as, like you said, the 99.8% tax act, the tax act for the 99.8% doesn't apply, that would make it so if the grantor is taxed on the income, and any income tax payments made on behalf of the trust isn't counted as a gift. So that's another way of getting more asset. You know, I sit there and I tell my clients the end goal is to get as much assets to your children, grandchildren, with paying the least amount of taxes as possible. So that's another way, and we've been doing that. It's not like we haven't been doing that. We're just seeming to do a lot more of it because of the potential that the exemption is going to be reduced. Maybe, and it could happen as early as next year. So, you know, Farhad, I'm sure you're having a lot of the same type of questions of, you know, when do
Yeah,
it happen?
having similar conversations, similar questions, and similar concerns. I think one thing, we went through this in 2012. 2012, it was sort of a tsunami of planning because we had a $5 million exemption that we was scheduled to sunset and drop to $1 million. And so, for a lot of the clients who had the capacity to make the $5 million gifts in 2012, we often created these trusts, and the conversation is really we're just going back to the same trust. So it's a little bit easier this year, particularly for those clients, because we're just topping off, we're just adding additional assets. We're not necessarily having to create new trusts. The other thing that's nice about maybe doing the planning this year as opposed to 2012 was there was a risk, there was uncertainty, or much greater uncertainty about what's called a clawback. That is, if you gift $5 million of assets this year, but then the exemption drops to $1 million next year or in a year in which you die, can the IRS claw back that extra $4 million of exemption that you gave away that you didn't have at the time of your death? As part of the 2017 tax bill, Congress was directed to, or IRS was directed to, issue regulations addressing the clawback, and they're favorable, and they essentially say that no, you can't claw this back. And so, if you give away $11.5 million this year and the Bernie Sanders bill passes and it drops to $3.5 million, they can't claw back that $8 million of gifts that you gave away. So that gives us, I think, a little bit more comfort and confidence in at least doing some of this planning before year end, or before, when some of these things may happen. And I guess really what we want to do, really sort of wrap things up, is maybe talk a little bit about predictions on what happens, and what the timing would be. I think there are a number of outcomes in terms of what happens. So right now the Republicans have the White House and the Senate. I think if obviously if Trump wins and the Republicans retain the Senate majority, I think a lot of, I don't think there will be a whole lot of change. I think really the focus will be on making the 2017 tax bill permanent and pursuing some of the things that Conrad, identified. But I don't see a whole lot of additional movement. If Vice President Biden wins, but the Republicans retain the Senate majority, then you've got divided government. And there's some folks who think that's a great outcome because, because of that divided government, it will be hard to do a whole lot. And so you, to a certain extent, you preserve the status quo. They may be able to eke out, some type of compromise, but, I think it's unlikely that we'll see a whole lot. If Biden wins and the Democrats have a slim majority, and it could be, I think by my understanding, I think the Democrats have to pick up 4 seats in the Senate, and I think that there are net 4 in the Senate, and that I think there are pretty close races. There are races where the Democrats are leading in, I think Maine, North Carolina, I think Arizona, and I think Colorado. And so you could have a situation where they do have a slim majority. That's a situation comparable to what we had in 2017, and going forward, where the Democrats using the reconciliation bill, which is really the appropriations bill coming out of the House, can essentially pass tax legislation using a 51-49 majority vote, which is essentially what happened, in 2017. And obviously, if Biden wins, at that point, Vice President Harris, if there was a tie, as president of the Senate, could break that tie. So, even at a 50-50, you have that possibility. And so that's going to be, at least some possibility there. And then obviously, if there's the blue wave, if Biden wins and the Democrats make, really significant gains in the Senate, then I think you have a situation where I think the tax legislation that you will see will be much closer to, the Biden proposals that Conrad talked about, in particular on the business corporate income tax side. I think, what a lot of folks are saying is they'll view that as sort of a mandate. They'll view that as a repudiation of the Trump agenda, and they'll say we've got political capital and we're going to spend it and we're going to do these things. One thing I will tell you is, and I've watched tax legislation for the last almost 30 years, is, you will see stuff come out of the House that say, that's great, but that ain't ever going to pass. The Senate has a strong moderating influence on legislation. It brings a lot more common sense to legislation. And so while you'll see stuff that comes out of the White House or the House of Representatives, once it gets to the Senate, it definitely is tempered quite a bit. And so, and even with I think if we have a slim majority among the Democrats, or even a strong majority, the reality is, a third of those senators are coming up for election in 22. And so they're going to be concerned about raising taxes. And so, I think that also has, has a moderating influence on what may be perceived as excesses and raising taxes. Flip side is that, that we've injected a whole, trillions of dollars into the economy in response to the pandemic. And, there's a sense that, at some point we have to pay for it. And so, how that comes out, we'll see. We'll obviously have more clarity next week. I would say from a timing perspective, I think there are a number of things that we're seeing and hearing, and I'd love to get Conrad and Christine's perspective on this. What I've generally seen is that if the Democrats, win the White House and also capture a majority in the Senate, I think their priorities, at least in the near term, are really going to be focused on healthcare, economic relief related to the pandemic, and then probably jobs creation, infrastructure type spending, and then I think taxes will be also part of that. I think there is a sense that at this point the economy is still fragile. While the stock market is up, a lot of businesses and certainly certain industries are hurting pretty significantly, and there's still I think 8 million people that are still out of work. And so I think the conventional wisdom is raising taxes in that environment is probably not a good idea. Let's get the economy back on its feet. Let's get a vaccine. Let's get people back to work. And then we can look at doing that. So my sense is, we may not see that at least until maybe the second half of the year. And it may be something we may not see until 22. The question is, well, what happens, if the legislation is enacted in 21, if tax legislation is enacted in 21, could they make it retroactive to January 1st? And I would say legally, yes, they can. It happened in 1993, where I think the tax bill was enacted in November of 1993 and was made retroactive to January 1st. And that case actually went to the U.S. Supreme Court, and it was held to be constitutional. I'll tell you an anecdote. We had a client who died in January of 1993, and I believe the estate tax at the time had been dropped as part of the Bush tax bill. I think it had been dropped from 55% to either 53 or 50%. And so the client died in January. His estate tax return was filed in October and so the tax return was filed, the tax was paid, and then this tax bill was enacted in November and made retroactive to January 1st. And so we had to send the IRS some additional money. And talk about an unhappy client, or obviously the client had passed away, but his family was incredibly unhappy. And I think doing something retroactive is very hard. My rule of thumb is if the legislation hadn't passed until by April 15th, it will get pushed out to the following year. That's just kind of having watched legislation over the years. I feel like once you get past April 15th, people will say, okay, we're done with last year's taxes. Let's look forward. And so, we don't know what will happen, but I think and especially doing a significant tax increase mid-year and then making it retroactive is tough. I think it's more likely that we would see something, if it is enacted in 21, that it would only become effective in 22. And just given where we are, I could see something happening either late in the year in 21, similar to what happened in the 2017, where it was part of a reconciliation bill, and it was passed in November, December, and made effective the following year. That's probably my best guess as to what I think will happen, but and that's obviously assuming the Democrats win both the White House and have a majority in the Senate. But I'm curious what Conrad and Christine might think on this.
Yeah, I think from my perspective, it's very similar to yours, and that was the one question we did get in their chat is, laws have passed in 2021, would they be retroactive, or do we think they go into 2022? And my guess is I've been reading a lot of the materials where, similar to you, if you get a majority in the Senate of Democrats and Biden, they're going to focus on 3 programs, and then they'll look at taxes, or maybe some of those programs have some tax increases in them or various, provisions. So it's really hard. I think Farhad and I and Christine get the question. I had 3 people call me yesterday, 3 deals, and, do we close 12/31 or 1/1? And I don't, my guess is as good as yours. My educated guess after reading everything is I don't think it'll be retroactive, but I could be really wrong. And it's really hard to make that decision. But I would say the articles are probably a little bit more in the majority of delaying this increase to fix the economy is what I'm seeing. But
you make a good point. I mean, the things that we talked about, pandemic-related economic relief is going to have a big price tag, and so, do they include a for the 99.8% type, tax increase tied to that bill and saying, look, we're gonna have the wealthiest folks pick up the tab for this.
I will say though that Christine made a good point. We're finally getting to the end of all the 2020 regulations that are being issued in 2020 for the 2017 law changes, and now we may have this other set of new laws that we have to integrate and start modeling, and I think really just think about planning. I'm sure you're going to hear from your accountants and your attorneys about rate changes and things that you can do. And one thing that we'll all guarantee you is whenever it gets put in the legislation, there's always flaws or ways to find holes in it to take advantage of certain things. And that's what we all do.
That's what we do. Christine, I'm curious to get your perspective on this.
Well, I know what the law is now, and I've been telling my clients, sometimes you don't want the tax tail to wag the dog because they don't pay the taxes until they're dead. So the impact of shifting assets irrevocably into a trust, even though we can build in a whole bunch of provisions in there, it's gonna change their lifestyle in some ways. Their balance sheet is gonna look very different. I've got a lot of developer clients who like to look at their robust or need a robust balance sheet financial statement so that they can take it to the bank to guarantee loans and to get loans. And if I'm taking $23 million off of it, it's going to affect what that looks like, even though, I assured them they're not going to run out of money. But the clients that are definitely, we should be doing this, we should have done it 2 years ago, we're going ahead and making the changes. The hardest one, I think, are the ones that are between 10 and 20 million, because, again, even if you only do one spouse giving their full exemption, you're cutting their wealth in half. And even though with the Spousal Lifetime Access Trust that works, what if that spouse dies? Then you're also limiting. and it's hard to know what's going to happen. You know, you and I, we were talking about this. We all, you know, went into the election 4 years ago thinking that it was going to have one, you know, all the polling, all the media, everybody was telling us it was going to be one result. I'm kind of glad now that nobody's making any kind of predictions. We just don't know, which is kind of good. It'll get everybody to the polls, and then we'll figure it out, hopefully sometime not too far after November 3rd. But you know, it's not easy. Like I said, the tax tail wagging the dog. You know what? I've heard of people thinking about going ahead and selling. You know, not because they were going to sell, but maybe selling to a child for a note or something, just so they could recognize capital gains, and elect out of the installment sale for this year, and go ahead and pay all the capital gains before a recognition event, which might make sense, because if you're changing, you're saving substantially a lot of money. But it's a really hard call to make, you know, and we wish we had that crystal ball, because I think even at the end of by the end of November, beginning of December, we're not even going to know, and something could happen, like you said, midway or towards the end of 2021, and make it retroactively January 1st, and it's going to impact us. So it's a really hard call.
Yeah, yeah. Well, I think hopefully we'll have at least a little bit more clarity a week from today, at least in terms of where things are headed directionally. And I think, you know, that those results will certainly inform the advice that we're giving to our clients. So I think it's just a matter of sort of watching the movie and seeing what happens, but then being prepared to act, and maybe act, you know, very quickly. You know, the nice thing, at least from our perspective, largely from what you and I do, Christine, is we're largely making gifts. We're making taxable gifts that are within a gift exemption, and so it's not like we're in a situation where we're necessarily triggering the payment of a tax, and so it's a little easier to gift than it is for the planning work that Conrad does, which really involves a sale transaction, and taxes will be paid. It's just less tax that will be paid, or, you know, hopefully less tax. And so we're sort of lucky in that regard. Well, that's great. Are there any final comments that folks want to talk about? If not, then we will go ahead and adjourn. We'll keep the dialogue box open for a second or two if anybody wants to pose any questions. We received that one question about timing, but if there are any other questions, feel free to type them in the box, or I think you've got all of our contact information on the screen. Obviously, you know how to get in touch with us. You're all clients and friends. So anyway, we thank you for your participation and attention, and you know, we wish you all well and stay safe. So thank you all.